Good morning to you all. Hello.
Good morning, sir.
Good morning. Good morning. So I think this is the last class on Module 6, that is on regulatory requirements. So I think last week we completed the Basel III, the concepts and what are the implications and how the Basel evolved over the period from Basel 1, 2 and Basel 3. So today I think we will go through the computation of market risk, the capital charge for market risk. Now, as I said in the last week, if you go to the Basel framework, so the pillar 1 covers three risks: credit risk, market risk, and operational risk. And there are different approaches the regulator can adapt for their country. For credit risk, we still on the standardized approach in Sri Lanka. For operational risk, most of our banks are still adopting the basic indicator. But some of the bank, the central bank has granted permission to move to standardized approach. So for operational risk, most of our banks are on the basic indicator, but some of the banks they adopt a standardized approach. With regard to market risk, there are two models: standardized approach and internal models. So at the moment, we are in standardized approach. So all our banks compute capital charge for market risk under Basel III framework according to the methodologies prescribed under standardized approach. So today, I hope we can study the standardized approach adapted to compute capital charge for market risk. And of course, I have ignored the computation framework for credit risk and operational risk. And because this is on Treasury, this is a Treasury related course. And therefore, whatever the risk related to the Treasury operation is the market risk. But anyway, as a people who work in Treasury department, you may not involved in computing the capital charge for market risk, because the entire computation is done by your finance department. So they, I mean, if we go into the technicality of these computations and all, so it is much relevant for a officer working in finance department and who actually involved in preparing this statement. But still, you need to understand how the capital charge for market risk is computed. Now that is relevant for your operation, because now if you have some knowledge on that, you can apply that knowledge in your dealing practices and your investment portfolio, and how to do the mark to market on a daily basis and how to maintain your positions, right? So that will help you. Therefore, I thought of ignoring the credit risk and computation of capital charge for credit risk and operational risk, but we'll study the market risk computation. So we've adopted the standardized approach for computing the capital charge or the risk-weighted assets for market risk. Now, when I say market risk, it covers three different risk, right? Interest rate risk, foreign exchange risk, and equity risk or equity price risk, right? So the scope of this computation and the coverage is basically to compute your interest rate related instrument in the trading book. So we take only the trading book for this particular computation. We are not going to take your banking book. Now there could be interest rate related instruments in your banking book. You may hold some instrument until maturity. Say for example, maybe preference share, investment in preference shares, investment in debentures, investment in perpetual debts. So all that you keep it for all your loans. So loan again, it's an interest rate related instrument. But all your loans are in Sri Lanka, we don't securitize. Therefore, our loans are in interest rate related instruments in the banking book, not in your trading book. But this particular computation, the market risk charge, will cover only the trading book instruments that carries an interest rate risk, right? And again, equity, similar, you might have some equity investments held to maturity, and some are in your trading book. So we consider only the trading book, right? Then with regard to the foreign exchange position, we take the entire bank, whether it's in your trading portfolio or in your HTM portfolio. But for foreign exchange position, we take the entire book, right? But for interest related instruments and equity price related instruments, we take only your trading portfolio for this computation. Now, then what happened to the interest rate related instruments in the banking book, where how the capital adequacy for that will be computed? Anyone?
That is covered under credit risk.
Okay, so under credit risk, we can cover only the default risk and concentration risk, not the interest rate risk. Now, under credit risk, we capture the default risk and the concentration risk. But this is an instrument in your banking book, not in your trading book. If it's in the trading book, we can capture or we can compute a capital charge under this approach. But say, for example, you have a perpetual debt. Preference shares, for example, we'll take preference shares, and it is perpetual, it's not in your trading book. So, and of course, there's no credit risk for that. Now, how we are going to allocate capital to mitigate any risk coming out of that investments is under Pillar 2. Now, I said there are two approaches, right? So, Pillar 1 covers a certain type of risk, and whatever the risk partly covered or not covered under Pillar 1 will be covered under Pillar 2, under ICAP, right? So remember that. So under Pillar 1, we compute capital charge only for certain type of risk. We compute capital charge for credit risk, but again, only the default risk we compute. And we compute capital charge for interest rate related risk. Again, it's only the trading book. We are not going to compute banking book. Equity price, again, we take only the trading book, and we are not going to cover a banking book. And FX risk, of course, we cover the entire thing, and any other risk. So there are partly covered risk under Pillar 1, and certain risk we fully cover, certain risk we partly cover, certain risk we don't cover at all. Right? So those risks, the capital charge for those risks will be captured under Pillar 2. So all your interest related instrument in the banking book, equity instrument in the banking book, and the capital charge for those investments comes under Pillar 2, not under Pillar 1, right? So under Pillar 1, we compute only the trading book in the case of interest rate and equity risk. And the coverage is instruments or securities classified under trading account. So banking books, we are not going to include under this computation. And equity position, again, the trading book position. And foreign exchange book position, the entire book will be covered. And the gold position. Now, gold position, again, it's computed within the foreign exchange position, right? So there's no separate item for for gold price risk, right? Again, depending on the price movement of the gold in the world market, there could be situation where banks can expose to risk. Now that's what happened in I think 2012 in Sri Lanka. And depending on the world market price for gold, there could be huge losses for banks, right? But that position we don't compute separately, but we include the capital charge within the foreign exchange position, right? But remember, the scope covers 4 items, even though we compute under 3 items. So the gold position is covered within the foreign exchange position. Okay, so then let's start with the interest rate related instruments in the trading book, right? Can you tell me some of the interest rate related instruments in your trading book? So what kind of instruments you can have it in your trading book?
Treasury bill.
Yeah, treasury bill is an interest related instrument, and generally that will be classified under trading book. Other instruments? Any other instruments?
Debentures.
Yeah, exactly. Corporate debentures. Again, it could be in the trading book or it could be in the HTM. But there is a certain amount of debentures that you put it under your trading book. What else?
Treasury bond also.
Yeah, treasury bonds. Again, yeah, treasury bonds. So it could be ISBs, international sovereign bonds, right? Then again, now I think I have told this maybe in the last class. The decision to put your investments, so you are going to, or your ALCO committee decide whether you are going to invest in treasury bills or bonds today, right? That's how the system works. Say for example, your ALCO meeting this morning, you decided that you are going to buy 10 million treasury bills, right? 10 million rupee worth treasury bills. At that point, the ALCO should decide whether you are going to put this in your trading book, in your AFS, in your HTM, or you can distribute. The 10 million could be divided among 3 portfolio. You put certain portfolio in trading books, certain portfolio in AFS or HTM. That decision should be made when the ALCO decided to make the investments. Now, it should be minuted also, right? So the minuting is important because now that is the only proof we have what is the intention of the bank at the time of making these investments, right? Or no, that is common for equity also. Again, when you are going to make an equity investment, ALCO should decide. So under which book this should be classified. So once you made the decision, it happens technically before making the investments. Once the decision for investment is made by the ALCO, ALCO should decide, okay, what portion of that investment should be put under trading book or AFS or HTM. So that decision needs to be taken at the time of investment, right? Now, once the investments are made by your dealers, based on the ALCO minute, you can distribute your investments into different portfolios, okay? And once that decision is made, okay, now say for example, you made a decision to put entire investment, whatever you are going to invest today, right? The ALCO decided, okay, we will keep all that 10 million in our trading book. So once that decision is made, you invested and you classified your investment as trading portfolio. Tomorrow you can't change your mind. So that is not permitted. Once the investment is classified into a certain account, right, of trading or HTM, AFS, then you can change or you can switch portfolio at a later date, right? You can, after 1 week, you can transfer your trading portfolio into HTM, and similarly, you can transfer HTM to trading, and that is not permitted. And if you want to do that in exceptional circumstances, right? To the rates, the yield rates are going to go for a 6, and bank will incur a huge loss that leads to a bank failure. That kind of a critical scenario, you can write to the regulator, you can write to central bank asking for, at the time of investment, we decided to put this under trading, but now our mark-to-market losses are very huge. So we want to transfer that to HTM. And you can make request for anything, to transfer from HTM to trading or trading to HTM, whatever, but you can't do on your own decision. You have to write to the central bank, and you need to get the central bank approval, right, for transferring investments after your initial decision. But now under IFRS 9 or SLFRS 9, there's another category called available for sale category, or AFS. Right? Before SLFRS 9, we had only, even though internationally there were three categories, but in Sri Lanka we had only 2 categories before IFRS 9. So at that time, we had only either a trading book or a HTM book. But with the implementation of IFRS, now we have 3 books, right? And if you want, you can keep certain amount of your investment in AFS book, available for sale book, right? Now, whatever the amounts in AFS, if you want to transfer that amount into your trading book, you are not required to get regulatory approval. So AFS is kind of an in-between thing, right? If you have your investment in AFS, you can switch to trading only, but you can switch to HTM, but still you can switch to trading depending on the market condition. And similarly, you can transfer your trading book investment into AFS without getting regulatory approval. Right, so AFS is kind of a transit. You can move from trading to AFS and AFS to trading without regulatory approval. But from trading to HTM or AFS to HTM, then again you need to get the regulatory approval, right? So with that basic introduction, we'll move to the interest rate instrument, how to make the capital charge. So measuring the capital charge for interest related instrument in the trading book, that includes your LKR portfolio and foreign currency portfolio. So whether you have investments in rupee debentures or dollar debentures, and it classified under trading book, then it is subject to a capital charge. Then there are 2 kinds of capital charge for this instrument, and that is at the current market value. So I think if you work in a treasury, you know that all your trading portfolio are marked to market on a daily basis. So the capital charge also computed based on your current market value, and there are 2 different type of charges. One is called the general risk charge. And this is why we say general risk charge is, this charge is made for your entire portfolio, right? So it's a general charge. It's kind of a general provision we have. You take the total portfolio and you make this charge certain percentage, right? So that is for the entire again, only the trading, right? Not the HTM. But now from now onwards, whatever I say, it's related to trading book. And so you take your total trading portfolio, and a percentage you need to apply in order to get the general risk charge. The second charge is specific risk charge. Now, this specific risk charge varies from instrument to instrument, varies from issuer to issuer. So each and every type of instrument, you need to make this charge again. For example, if a instrument issued by the government, treasury bill or treasury bond, the specific charge computation is different from a instrument issued by a corporate company. Take a treasury bill and a corporate debenture. This specific risk charge is different for those two instruments. So you apply a certain method to compute specific risk charge for a government issued instrument, and you may apply, you have to apply a different method to compute specific risk charge for a corporate debenture, right? So remember, there are two types of capital charges. One is a general risk charge that will be applied, or the same method will be applied for your entire trading book, and specific risk charge depending on the type of the instrument and the type of the issuer who has issued that, whether the government has issued or whether a corporate company or a public sector enterprise, right? Or whether it's a local issuer or a foreign issuer. Depending on that, this specific risk charge changes. Okay. Any clarification you need so far?
So when it comes to now as so far what I can understand is you need to put the market risk basically on this what you book under trading book. If to avoid put this capital charge, if banks used to book all their assets in the AFS category and do their trading, is there a specific regulation or this thing issued by central bank, or how can we identify something?
Yeah. At the moment, of course, your bank can do that. You can have it on your AFS to avoid this capital charge. But only thing is your risk management department will not permit that. Right. So we have some internal controls now. So your risk management, your integrated risk management is an independent department, and they have a separate reporting line and all. But what you can do is now you can minimize. So that is there. So you can play with numbers. You can shift. You can have your portfolio in the trading book for the first 25 days. And when the month ends are nearing, you can transfer that to avoid that. Still possible. But that's what I said. This culture is important, right? Compliance culture and risk cultures are important. So if a prudent bank, right, a prudent bank with a good compliance culture, they may not do this. But again, and it is the risk management or integrated risk management department or the CRO of that bank to ensure that all your risks are managed properly. Right? Otherwise, the bank again go and you have to face a lot of consequences. And whenever the on-site examination from central bank, the examiners comes to your bank, they go and check all these transfers. Now they take a list of instrument transferred between these two categories, right? So if they found that the bank is purposely shifting between buckets to avoid capital charge, of course, we have so many other regulatory actions and all. So, but you forget about all that regulatory sanctions and your risk management department, our on-site supervision. Technically, you can do that, right? So technically, you can do, because now all what you are reporting is a quarterly. This is a quarterly report. So of course, for more than 2.5 months, you can keep in the trading book. And when the quarter ends nearing, you can simply transfer that to AFS so that you may not have a capital charge uh, for this particular instrument. That is possible, right? So technically it could be done, but only thing is we have some other indirect way of controlling that through your compliance, through your risk management department, and through the central bank examination, right? So there are ways to minimize that, but still, if a bank wants to do that, they can do, right?
If bank is continue to book their all their investment under the AFS and do their trading, no need to transfer. No, like they can use the AFS as the trading book. In such instance, how can we identify such things? Maybe by looking at the profit or the like. They, they
Only good thing is now whether you keep it in your trading or AFS, as per SLFRS 9, it has to be mark to market on a daily basis, right? So only thing where a bank can kind of take a misuse this is this capital charge computation only. Anyway, you have to mark your AFS or trading. Therefore, whatever the mark to market loss will come to your P&L through OCI, other comprehensive income. So that loss is already absorbed by the accounting standard. So on top of that, a bank can avoid this capital charge. That is possible, provided if you don't have a good compliance culture and a proper risk management uh, division or mechanism in your bank. Still, you can do that. But anyway, the mark-to-market loss is captured through the standard, right?
Yes.
Okay. So technically, if a bank wants to avoid capital charge, they can do whatever the way you said. But I don't think our banks are doing that, provided you have a proper integrated risk management systems in your bank, right? And of course, I don't know whether I mean, I'm not aware of your background, right? Now, if you are working in a treasury at the moment, I can understand the point where you are coming from, right? But anyway, that is not relevant. Your position and your banks are not relevant for this study. Now, after this COVID issue, and the markets are not active, and certain bank, right, not all, a few bank, they actually wanted to do this manipulation. And again, I'm not going to tell the names of banks. And maybe you are coming from that bank, right? Now, I realize that because the way you asked the question, or maybe you're thinking on your own. So anyway, it's not relevant. Certain bank, of course, they didn't go and did this manipulation, but they are frank, right? And their risk management also aware of this, but they come to central bank and asking for now, because of the COVID, we are actually, incurring a big loss, mark-to-market loss, and which is already captured through the IFRS standard. So on top of that, they wanted to shift this to AFS. And I think one or two banks, they wanted to shift to HTM also. So, and it's actually not a manipulation, but banks were asking from the central bank whether we can do this, provided there's a huge loss, right? And I don't know whether you're asking the question from that angle, right? And now this is a crisis situation. This is an exceptional kind of a situation, okay? And of course, I'm not aware what the central bank decision on that, because that is not relevant for my division. So we only make policies. So that actually handled by a separate division within the bank supervision department, and that is called the offsite supervision department. And I'm not aware of their decision, whether they permitted or not permitted, I'm not aware. But say whether they permitted or not permitted, and it is with the knowledge of the regulator. So bank is not, it's did that disguising or manipulating or, without the knowledge of regulator. That is not the case. They know and they understood there is a possibility within the regulation to manipulate, as you said, and they understood that. And last week also I said bankers are smarter than regulators, right? So similarly, our smart bankers, they come up with some, they found it could be manipulated within the direction, because direction is not not prohibiting that. Right, so there is a possibility of doing that, but they requested the permission of the regulator to do that manipulation. Right, now, even say for example, central bank permitted that, and that is okay. Right, now these regulations are not the hard and fast rules. Right, regulation could be flexible, and that is one specialty of regulation. You should be able to give exemption depending on a crisis situation or an unexceptional exceptional situation, and that is fine, right? If you know this, you went to the regulator, you get the permission of the regulator, you did this manipulation, that is perfect. There's no harm, right? So only thing is you can't manipulate without the knowledge of the regulator. If you are going to do that, then there is something wrong with your risk management department.
Okay.
Okay.
Okay. Thank you, sir. By the profession, I am an auditor. Like that's why I'm asking.
You are an auditor. Okay.
Yeah, because I am always with this regulation and all.
So
like,
as an auditor, what you said is, your thinking is exactly correct.
correct. Yeah.
Correct. So if
That's
you are
the
an
thing. They just
auditor in
want.
a different role, so you are
Yeah.
supposed to find out that kind of manipulation. So you are
Correct.
absolutely correct, right?
Yes.
But just check whether they did that manipulation with the approval of the regulator.
Okay.
Right? Now, this COVID, we have given lot of exceptionals or lot of exemptions to banks from our normal regulation. So please check whether they have done that manipulation with the knowledge of the regulator. If that is the case, it's perfect and fine. Right?
Correct.
Okay.
Thanks.
So one question.
Oh.
So whenever bank want to make an investment in particular, let's say bond or corporate or whatever, has the CBSL issued any investment direction on that transaction?
Yeah, there is a direction, and that is called classification of norms. I can't remember the exact name. Just give me a second, I can check and tell you. It was issued in 2012, I think, and there is a direction. Now, at the moment, now we have reviewed that particular direction, because now whenever we issue a regulation, we have a process. Every 5 year, every 6 year, we have to review that and we have to amend to suit the current market development. So with the implementation of IFRS 9 in Sri Lanka, we have to amend that particular direction, and there are few more directions which we need to amend. So we have already did a consultation paper on that, and that is issued to banks now. And if you are work for a bank, you may check that. So once we receive the observation from the bank, we will go and do the necessary amendments. So the amended direction in line with IFRS 9 will be issued before end of this year. But still, at the moment, we have a direction for that, this classification and everything, which I just told you, basically from that direction, right? So the requirements of the direction Yeah, prudential norms for classification, valuation, and operation of banks' investment portfolio. That is the regulation. Prudential norms for classification, valuation, and operation of banks' investment portfolio.
So when is it issued? Will you able to let us know that?
Yeah. Tell me.
Can you repeat the classification?
Yeah, direction on prudential norms for classification, valuation, and operation of the bank's investment portfolio. So it was issued in 2006 actually, 1st of March 2006.
Thanks.
Right. So the new direction, the amendment to this direction in line with SLFRS 9 will be issued before end of this year, and already we have submitted a consultation paper to the industry to get their observations. So once we received observation from banks, and we'll do the necessary amendments and issue the final direction. Right. So for the time being, if you want, you can check that particular direction where you can see whatever I just told you is there. Right. Okay. So any other question? Okay, so we can continue for the interest rate computation. Again, the general risk. So this capture the loss arising from changes in market rate on portfolio basis. That's what I said. It's a general thing. So you take your entire trading portfolio, you apply this capital charge, and that is to cover the losses arising from changes in interest rate risk. Then actually there are two methods the Basel prescribed. But we use the duration method. So our computation of general risk charge is based on the duration method. Then there are some disallowances given by the Basel committee, which for Sri Lanka we have not permitted. So the vertical disallowance, horizontal disallowance are not permitted at the moment. And the computation is based on a assumed change in yield, right? But this assumed change in yield is given by the regulator. Okay. Say for example, you have a treasury bill which is maturing in 1 year, say in 10 months, right? So you have a treasury bill in trading book and it will be maturing in 10 months time, right? So the regulator says, oh, of course the Basel committee, right, says if an instrument matures before 1 year, anything below 12 months, the assumed change is 2%, right? And if the instrument matures within 1 year and 2 years, this is the change. If it's between 2 years and 2.5 years, this is the change, right? So that change is already specified. Okay. So this is that table, right? So, and if you can see that forget about these maturity zones, because that is applicable for the vertical and horizontal disallowance. For Sri Lanka, it is not permitted anyway. You all can see the slides, no?
Yes, so we can see.
Okay. So forget about this maturity zone. So that is applicable if there is disallowances, but in Sri Lanka we have not permitted. And you can see these are the same change in yield given by the regulator or the Basel committee. Now, as I said, anything below 12 months, your change in yield is 2%. You need to assume that your yield will change by 2%. And if it's 1 year and 1.9 years, right, the remaining maturity. So we are not going to consider the period already passed. Always, now this is based on mark-to-market value. Always we focus on the remaining maturity of the instrument. What is the remaining maturity? Now, if the remaining maturity is between 1 year and 1.9 year, the assumed change is 1.8%. Similarly, for different maturity buckets, a regulator has specified what is the assumed change. Right? Now, the computation for general risk charge is simple. You understand this. Right? So calculate the price sensitivity of each instrument in terms of change in interest rate depending on the remaining maturity of the instrument. So the important thing is all these computations are based on remaining maturity, not the original maturity of the instrument, right? Now the computation is, initially you have to compute your mark-to-market value of the treasury bill, right? Now, how do you compute your mark-to-market value of your treasury bill? What are the inputs we need? So you are going to compute the mark-to-market value of your treasury bill portfolio. So what are the information or what are the data you need?
Redeeming value.
Sorry?
Maturity value.
Yeah, remaining maturity period. Yes, that is one input you need to give.
The face value.
Yeah, face value of the instrument. Yes. And your yield rate, the interest rate is important. So we need to input the face value of the instrument. What is the yield rate of the instrument or the interest rate of the instrument? And what is the remaining maturity of that instrument? So by applying these three, you can compute your portfolio's mark-to-market value. Okay. Now we'll take an example. Your face value of the treasury bill is 100 rupees. Right? 100 rupees. And the interest rate or the yield rate is 1% or 10%. Okay. Say 10%. And remaining maturity is 10 months. Okay. So by multiplying 100 rupees into 10% into 10 months, I said 10 months, right? Okay. So 10 months. So you multiply your face value with the interest rate of or yield rate of 10% and remaining maturity of 10 months. Then you get the mark-to-market value. Okay. Say your mark-to-market value is 90 rupees. Right? Then again, you need to apply the same formula by assuming that your yield rate will be changed by what percentage out of this table? 2%, because the remaining maturity I said 10 months. So 10 months is this bucket, the rate is 2%. Okay. Then you need to compute again the market value for the same instrument, assuming that your yield rate will change by 2%. Now tell me what are the information you need to input. What is the face value you will input? ₹100. Face value is same, it will not get changed. And the yield rate, now previously the original yield rate is 10%. So you inputted 10% into your formula, but now we assume that the yield rate will change by 2%. So what is the new yield rate? 12%, 10 plus 2, 12. And remaining maturity is 10 months. Okay. So you need to compute the market value based on original numbers, based on real numbers, and based on assumed change in yield, right? So you have to compute 2 times. Now by assuming that your yield rate will be 12%, say for example, you end up with a mark-to-market value of 95. So based on the original computation, your mark-to-market value is 90. And assuming that your yield rate will go up by 2%, your mark-to-market value is 95. Okay. So the general risk charge is the difference between new market value, that is 95, and original market value, that is 90. So 95 minus 90 is 5. So 5 rupee or whatever, 5 million or 5 billion, that is your capital charge for general risk. Okay. Any confusion or you understood easily? Is that clear?
When it comes to previous market value, it comes like the previous quarter or the...
No, this is daily basis. You know, say for example, you are preparing the capital adequacy return for 31st March 2021, or we'll
Okay.
take December 2020, and you need to take what is the rate on December 31st.
So if you want, you can use the whiteboards.
Whiteboard, I think now this need to be changed. So this the setup is a bit difficult. If I write now, you will see that upside down. That's what they said. I'll try to do that, and I want to do that. There is some modification I need to do in this setup. Just see. I'll say this is 100. Can you see properly, or it's upside down?
Properly.
Properly.
Yeah.
Okay, okay. They said it will show you a upside down picture. Okay. Need to find a duster. Okay, I'll draw a square. So just tell me whether you can see this.
Can see, sir.
You can see properly, no? Okay.
Yes.
Right. Now, say for example, this is what is today? 25th. So 25th October 2020, you are going to do the computation today, right? And today you have a treasury bill of 100 rupees, right? And today your yield rate is the same example I'm taking, right? 10%. And this bill will mature in remaining maturity, will mature in 10 months, right? 10 months. So now, first of all, we need to compute the market value. So the current market value, so today we are going to compute the market value. We need to input the cost into 10% into 10 months. So 10 months means roughly 300 days, right? So this is how you compute the current market value. So say for example, you arrive at 90 rupees. This is your current market rate. Now we need to compute the same computation, but assuming that your current yield rate will be changed by 2%. So the same computation, 100 into now 10 plus 2, 12%. into 10 months. Right? So this is the answer. You get a 95 rupees. So your capital charge for general capital charge is 95 minus 90. 5 rupees is your capital charge for general risk. Okay, it's clear now. So only thing is your yield rate will change. Now same example, right? Same example. Say your it's not a treasury bill, this is a treasury bond, right? And for a treasury, okay, then I don't want to use that example because for treasury bond the formula is totally different, right? Now this work only for treasury bills. Okay, so anyway, I have given some computation. So this is the treasury bill instrument. These dates are somewhat older dates, so forget about that, right? Because I'm using the same slides from 2018. So treasury bill instrument, the computation date is 31st December 2018. And why I put assumed change in yield is 2%? Any reason for this? I said assumed change in yield is 2% without looking at the remaining maturity. Is there any reason for that?
Since this is a treasury bill.
Yeah, treasury bill is always 1 year bill, right? So treasury bill cannot have a maturity date over 12 months. So the remaining maturity should be less than 12 months. And depending on this table, we know any instrument with a remaining maturity less than 12 months, the rate is 2%. So that's why I could put here. Otherwise, I need to go and see each instrument. Now you can see that in the treasury bond computation. But for treasury bill, simply we can say the change is 2% because the maturity period of a treasury bill is 12 months. So the remaining maturity can't go beyond 12 months. Okay. Now say on this date you have this much of treasury bills, right? So these are individual bills, right? And these instruments are invested in different dates. Therefore, you have a different maturity dates, right? So this instrument will mature in 20th January 2019. So similarly, you have different maturity dates for different instrument, and therefore you can compute the remaining period for maturity, remaining days for maturity. So one example I can tell you now, this is 31st December you are computing 2018 and your instrument matures in 20th January. Therefore, you have a remaining maturity of 20 days. I have put all this in days. If you want, you can have it in years, no issue, right? So, and this is 20 days. And similarly, December 31st you are computing, maturity is 3rd February. Therefore, technically we have 34 days to maturity. Similarly, for each instrument, you need to compute the remaining maturity date. And of course, the current yield rates of each instruments are given. So again, you will have various yield rates depending on your investment date and the maturity date, right? So when it comes to market value, you need to input all these three: face value, remaining maturity, and yield rate. So you compute the market value, right? Now, of course, now this is if you compute all your instrument, and this is what your total. So the current market value of your total treasury bill portfolio in the trading book. Then we need to assume that the change in yield is 2%. Therefore, for each instrument, you have to add 2%. So 9.45 plus 2% is 11.45. And similarly, 9.68 and 11.68, right? So all the instrument, you need to add 2% for the current market rate. Therefore, you get a new market rate. And again, you need to compute the market value applying the new market rate. So your face value will remain same. The number of days to maturity will remain same, but the yield rate, you have to apply the new rate. Then similarly, you need to compute your new market value. So the general risk charge is the difference between new market value and the original market value. If you do the same computation for all these instruments, your general risk charge is new market rate, that is 863.22 minus 800. I think the other way around. Yeah, market value minus new market value. So 866 minus 860. So the general risk charge is 6,456. Okay, but this is for your portfolio and general risk charge. For specific risk charge, the regulation says if it's a government instrument, there's no specific risk charge. Right? I said specific risk charge depends on the type of instrument and type of issuer. The regulation says if any instrument issued by the government of that country, if the Sri Lanka government instrument, right, then the specific risk charge is 0. So you have only general risk charge of 6,456. Okay. Now we'll go to the specific risk charge. So securities issued by government of Sri Lanka or the central bank, specific risk charge is 0%. But the security issued by a foreign government or a foreign central bank, right? If it's only the local government and local central bank, specific risk charge is 0. But if it's a foreign government or foreign central bank, it depends on the rating of that country, depending on the sovereign rating, right? Then if the sovereign rating falls between AAA to AA minus, the capital risk charge is 0%. And if it's A to BBB minus, then again there are 3 different rates you can apply depending on the residual maturity, depending on the remaining maturity. If the remaining maturity is less than 6 months, the specific risk charge is 0.25, right? And if the residual maturity is more than 6 months but within 24 months, the rate is 1%. Any remaining maturity exceeding 24 months, the rate is 61.6%. For any other rating, anything below BB minus, it is the required total capital ratio including buffers. Now, if it's a elastic asset for a DC bank, 14%. For non-DSIB bank, 12.5%. So depending on whether DSIB or non-DSIB, you need to apply 12.5 or 14% if the sovereign rating is below BBB minus. So this is how we compute specific charge for a security issued by foreign government and foreign central banks. So then we'll take a bonds, right? Now bonds, we know the maturity period may be 1 year to 30 years, or maybe 50 years. Sri Lanka, of course, we don't have a 50-year bond, but I think we have 30-year bonds. But there are countries where you can get a long-term bonds, right? So remaining maturity could be anything. It could be less than 1 month, less than 1.6 months, less than 2 years, or anything, right? So depending on that, the yield rate we need to check and import. Okay. Now there, in this example, I have given 3 types of bonds. Now, first one is a UK government bond. Therefore, it's a bond issued by a foreign government. Right. The second one, US Treasury. Again, it's a foreign bond issued by a foreign government. Third one, Ford USA. So this is a company, corporate company, right? And again, it's a foreign company, not in Sri Lanka. Okay. Now you have the face values and dates to maturity. So the UK government bond is maturing on 2nd February 2020. And US Treasury bond 1st January 2021, and the Ford company bond 1st March 2020. And the yield rates are given. So this is, you need to get the yield rate available on the date of computation. Again, the date is 31st December. So you need to get what is the applicable yield rate on 31st December and apply here. So you compute the market value, but of course you can't compute the market value as I said in the example here. And if you are using a Excel, there is a formula, right? A market value for bonds. So you need to apply that formula and get. You can't do manually this computation. But anyway, treasuries, you have your systems are automated. So the report gives you the final number only, right? Final number only. The computation is done by the system, so don't worry. But you need to understand how it is computed. That conceptual knowledge you should have. So first you need to compute the mark-to-market value using the formula. If you're using an Excel sheet for yield formula, you have to use that. Then now the second part, we need to assume that the yield will change depending on time to maturity. Therefore, first of all, we need to compute time to maturity in years. So don't compute in days like treasury bill, because treasury bill, this table will not change, right? This table is same. So you can easily do with the number of days. But bonds, when you go beyond 12 months, the Basel table is given in years. So 1.9 years. This is not in days, not in months. So this is in years. All these are in years. Therefore, we need to compute the time to maturity in years. Right? So the first instrument will mature in 1.1 year, second one in 2 years, third one in 1.2 years. Right? Then of course you need to go back to that table. If the time to maturity is 1.1 year, what should be the assumed change in yield? 1.1 year falls within this bracket, right? 1 to 1.9 years. So it will fall within this bracket. Therefore, the change in yield is 1.8. And similarly, the next instrument, 1.8. The next instrument is 2 years. For a 2-year remaining maturity, the assumed change, so 2 year falls under second bucket, this bucket. Therefore, change in yield is 1.6. So you apply 1. Similarly, for each and every instrument, you need to check what is the remaining maturity in years and what is the corresponding change in yield. So now you can add the change. You can add the change in yield to your original market rate to get the new market rate. So 9.67 plus 1.8 is 11.47. Similarly, 4.67 plus 1.6 is 6.27. And again, you have to compute your market value using the new market rate. So now you have the original market value and the new market value. So the difference is, the general risk is the difference between two markets value, the market original and the new market value. So you get for each instrument, you get what is the general risk charge. Then when it comes to specific risk, again, all these instruments are issued by foreign governments and foreign corporates. Therefore, you need to get the specific risk charge depending on the rating. So then you have to get what is the sovereign rating of UK, what is the sovereign rating of US, and what is the rating, external credit rating for Ford company. In this example, the UK government has this is not the exact rating, but these are only for example purpose. So we assume that UK government rating is A+, and US rating is AAA, and the US Ford company has a rating of A+. So then again, you need to check the regulation. Right now, regulation says for a foreign government and central bank, if it's a AA to or AAA to AA minus, rate is 0. We know for US government, it's a AAA rating, therefore specific risk charge is 0. Now we'll check UK government, the rating is A+. So A+ fall to this bucket, second bucket. But again, that second bucket has 3 type of charges depending on the residual maturity, right? So then we have to see what is the remaining maturity for that instrument, right? For UK government, the remaining maturity is 1.1 year. Okay, 1.1 year. So that falls within, so 1.1 year means it's more than 6 months, but less than 24 months. Therefore, the assumed change should be 1%. So you put the capital charge is 1%. Sorry. Specific risk charge is 1%. Then we'll check corporate US Ford corporate company. So now the rating is A+. What should be the specific risk charge? And you need to know what is the remaining maturity. So remaining maturity is 1.2 year, rating is A+. What should be the specific risk charge percentage? Anyone?
So what is the question?
Now, I'm in the third example, which is a corporate company in US, right?
Okay.
Their rating is A+, and the instrument remaining time maturity is 1.2 year. Okay, so then you need to find out what is the specific risk charge rate, right? So what should be the rate depending on this A+ rating and 1.2 year remaining maturity? Of course, you can't use this table because now this rating is given only for a security issued by a foreign government or a foreign central bank. But this is a foreign corporate company. Okay, therefore you can't use this table. And there's another table given. Now this is security issued by local corporates and foreign corporates, right? Now for a local corporate, again it depends on the rating bucket and time to maturity, right? Rating bucket and time to maturity. And in the case of a foreign corporate, there's no separate table. You have to use this table, but Now say for example, the rating is A and remaining maturity is 1.2 years. So that is more than 6 months and less than 24 months. So 1.6 now. Instead of using 1.6, you need to go one notch below, right? You need to take the next highest thing. So that is 10%. You need to apply 10%, right? So now can you tell me, for this Ford company, they have a rating of A plus and their time to maturity is 1.2. 1.2 years. What should be the rating? Okay. Yeah, I think maybe difficult. Okay, don't worry. And now, that's what I said. These computations are very difficult to explain over a online class. So remember now, what you need to remember is specific risk charge. It depends on the charges depends on external rating and time to maturity, right? Now, in the case of a Sri Lankan government or Sri Lankan central bank instrument, specific rate charge is 0 for the local government and local central bank. For any other kind of exposure, it could be an instrument issued by a foreign central bank, foreign government, foreign corporates, local corporates, anything, specific rates depends on external rating and time to maturity. Right? So don't get confused. And anyway, in practice, you are not required to do this computation. Banks are having systems in place of your VAR model or whatever the value at risk models your banks are using, that will compute. So you need to change your yield rates only. So the final output you get automatically. Then it's a subtraction only. So then we'll move to equity risk. Again, equity risk, we need to take the position in the trading book. Equity is in the trading book. And when we say equity, that is not only shares, but that also include instruments similar to shares, right? Not the ordinary shares, but also unit trust, warrants, bonus issue, right issue. So instruments similar to equities also need to be computed here. Again, equity risk also has a two type of risk charge, general risk charge, and for the total investments in equity, and specific risk charge. Now here the specific risk charge depends on which price index that particular share is listed. Now in Sri Lanka we have two index or two basic index. So, and we know for the best companies are listed in S&P SL20, and we have a all share price index also, right? And there is a Diri Savanay or Diri Negoma index. Can't remember. Diri Savia maybe. Yeah.
Sir, it's Diri Savi.
Diri?
Diri Savi.
Diri Savia, na? Diri Savi.
Diri Savi, sir.
Right. Okay. So all that's what we have. So it depends. Specific risk charge depends on in which share index that particular instrument is listed, right? So then we'll check the computation example. So you have invested in all these companies, right? All these companies shares, and the share values are given. For general risk charge, as I told earlier, this is for the entire portfolio, right? Now you take the entire portfolio of investment in trading book and apply what is your capital adequacy ratio. It could be 12.5 or 14%, depending on whether it's a DSIB or non-DSIB. For my example, I have taken a normal bank. So that's why this is 12.5%. So multiply your total value by the capital adequacy ratio, then you get the general risk charge. In order to get the specific risk charge, first we need to identify what is the price index. John Keells is listed in S&P, and similarly in this example, some companies are listed in S&P and some companies are all share price index. So if it's a S&P index, then you need to multiply that with your tier 1 capital ratio, required tier 1 capital ratio, including buffers. Last week I said in Sri Lanka our tier 1 ratio is 8.5%, including buffers. So that include buffers. So including buffers, 8.5%. If you want, you can go back to the previous slides and see. So you multiply by that, right? And any other share price index, you need to multiply by the required total capital ratio, again including buffers. So if it's for all these risk charge, the capital charge is taken by multiplying respective capital adequacy ratio. For general risk, this is the total capital ratio, including buffers. For specific risk, if it is listed in S&P 20, multiply by tier 1 capital ratio. And for other instrument, multiply by total capital ratio, right? So, and general risk charges for the portfolio multiplied by the total capital adequacy ratio. For S&P, multiply by your tier 1 capital ratio. And for other share price index, multiply by total capital ratio. If it's a DSIB, it may be it should be 14%. For a non-DSIB, 12.5%. Then FX risk.
So one question.
Okay.
So when we say the value of the shares, which means market value or the original investment value?
No, market value.
Market value as at the calculation date, no?
Yeah. So all the trading book should be at the market value, right? So this also, if you are computing today, you get the share price of John Keells today and multiply by number of shares. So that's how you get the market value. Right?
So when it comes to Sri Lankan banks, have Sri Lankan banks maintaining US Treasury bonds in trading books? Like what is the practical scenario? Like do they maintain in the Dtrm or the trading book? Just want to know that, like, because it was a dollar investment. What we found, like most of banks prefer to maintain in Dtrm. What is the real aspect of that? Sir?
To be frank, most of our banks, they don't have investments in the US bonds.
Yes.
But there are few banks, they keep it for HTM, held to maturity. Right? Only few banks. I think maximum 3 banks. I can remember 3 banks, but not all banks, of course. The ISBs, most of our commercial banks have, not specialized banks. Commercial bank, I think all of them have some sort of ISB investments. Right?
Okay.
No. So that is how we compute capital charge for equity risk, general risk charge and specific risk charge. So now we move to FX risk. I said earlier, FX risk, we take the entire book, not only trading book, the entire book. And this computation is done based on the position, the net open position. I think last week I explained what is the net open position. So you need to take the net open position in each currencies and gold position, right? So that is the first step we need to do. So you need to break up your balance sheet currency wise. If your bank is dealing in 15 foreign currency, you need to have 15 columns, right? So each currency, if you are dealing in, you can have a separate computation, right? And again, the next column will be gold. So if you are dealing in 15 currency, you will have 16 columns. So 15 for 15 different countries, and the last one for gold. If you are dealing in 5 currencies, you have to have 6 columns. 5 foreign currencies, different foreign currencies, and the gold, right? Then the off-balance sheet position also will be included in the computation of capital charge. So all the off-balance sheet items like the LCs, again in foreign currencies, derivatives, maybe there could be forward purchases, forward sales, swaps, so all that. And there could be guarantees, shipping guarantee or bank guarantees or any other performance guarantees given in foreign currency. We are not going to take the rupee exposure. So if there is any guarantees in foreign currency, we have to take that. LCs, of course, mostly in foreign currencies, so we need to take that. And forwards and swaps, you have to take the foreign currency leg of that, right? Swaps, of course, there could be two rupee leg and a forward, rupee leg and a foreign currency leg. So you need to take only the foreign currency part, right? So simply you need to include all your off-balance sheet foreign currency exposures, and net position in each currency should be computed. So that is your foreign currency assets minus foreign currency liabilities. So you need to compute what is your foreign net open position in each currency, right? And we use a method called shorthand method. I will explain what is that. Okay, so now I said each, you have to have separate column for each currency. So report your foreign currency assets in dollars, pounds, euro, yen, like that. Then foreign currency liabilities in dollars, pounds, euro, yen. Then you get your net open position in dollars, how much, and GBP how much, and euro how much, and Japanese yen how much, like that. The shorthand method means, and when you compute the net open position, there could be some position in long position, some may be short position, some currencies, right? It depends on your holding of position. So you might have hold a long position in certain currencies and short position in certain currencies. So shorthand method says you add up all your long positions separately, add up all your short positions separately. So now you have the total of long position and total of short positions, right? Then you take whichever is higher. Say for example, you have your short positions are more. Your short position in 1000, short position is 1000, long position is 900. Then the shorthand method say you take the 1000 but ignore the sign. Don't put minus 1000, right? You have to take the amount only, ignoring the sign. Okay, so that is shorthand method. And each foreign currency and gold converted at the spot rate into reporting currency. Again, I will explain with the example. And for FX position, the sum of net short position or sum of net long position, whichever is greater, but you can ignore the sign. So we'll check an example, then it will be more clear. Now this is your net open position. So you have different currencies, 1, 2, 3, 4, 5, 6 currencies in this example. If you have 15 currency, you have to have 15 columns. Then for each currency, we need to compute the net open position. That is foreign currency, dollar assets minus dollar liability, GBP assets minus GBP liability, yen asset minus yen liabilities, like that. So then you have to have net open position computed for each currency. So since we are using the shorthand method, it says add up all the long positions. So all plus 100,000, 50,000, 100,000, altogether 250,000. And similarly, you add up all your short position, that is 200, 300, 450. Now you have a short position of 450,000, long position of 250,000, and take whichever is higher. So that is 450,000, and then you ignore the sign. So you don't put negative minus 450,000, but we put only 450,000, ignoring the sign. Then similarly, you need to compute the gold position and your gold purchases and gold sales, right? So the net position now in this example 500. Therefore, the capital charge for your the foreign currency and gold position is, so together it's 500,000, right? 450 plus 50, 500,000. So the capital charge for your foreign exchange and gold position, that is 500,000, computed similarly by multiplying your total capital adequacy ratio. So it could be 12.5% or 14%, depending on DC or non-DC. Right? So this is how we compute capital charge for foreign exchange and gold positions. Okay. Now the one of the common mistakes in bank is, now they have the major currencies, right? So they have separate column for dollar, pound, euro, and Japanese yen. So those are the major foreign currencies in Sri Lankan banks, and others are small foreign currency. What they do is they have separate column for major currency, and they have one column saying all other currency, right? All other currency. Then they net all other currencies. They take the net position. That is not correct. Then the concept is ignored. Now, why we compute the capital charge on currency wise for different column for different currencies? The currency risk differ. So the currency risk of dollar is different from currency risk of pounds, and it's different from currency risk of euros, right? So if you put all other currencies under one column, that capturing a capital charge for currency risk is not properly done, right? So that's why we say don't put all other currency. So if you have 15 currency, you have 15 separate columns, right? And the other thing is, now you report to central bank in rupees. Now these are LKR, right? So these are LKR value. So you need to compute your dollar into rupees, pound into rupees, Japanese yen into rupees. Now if you put all other currencies, then it's not clear. That's what I say. The currency risk is different. Exchange rates are different. The currency risk is different. Therefore, you can't put the non-core currency under one bucket. So even the exposure may be less, you have to compute it separately, right? Because you can't report the return is in rupees. So every currency you have to convert into local currency using the exchange rate on the as at the reporting date, right? Therefore, if you put all other currencies, then that computation not correctly address the currency risk. So that is not correct. So once you've done that, now you can compute the risk-weighted assets for market risk. So now you have treasury bills, specific general risk charge and specific risk charge. Foreign bonds, you have computed. Equities, you have computed. Foreign exchange and gold position, you have computed. So that you have a general risk charge of 175,348 and a specific risk charge of 86,607. Now, both together is the total capital charge for market risk. Right? This is the total capital charge for market risk. Okay, any question? I know.
So where is that foreign exchange risk is there? I couldn't.
What is that?
That what is little while ago we created calculated the foreign exchange risk. In that computation, in which column that this capital charge will come under? Capital charge for forex. Right. Okay, sir. Thanks.
Because there's no specific charge for foreign exchange position because we have taken the net position and gold also net position. So then no specific risk charge. We can put it under general risk charge. But
Okay.
there's no harm if you put under specific because anyway, at the end of the day, you are going to take the total of both. So it is not wrong even if you put under specific risk charge. But
Okay.
generally, it is the general risk charge.
That means at the end of each quarter end, you need to take the whole net open position of the foreign currency, and that need to be converted into LKR.
First,
Then only. Yes. Okay.
Then you need to compute the position, net position, and take all the pluses separately, all the minuses separately, and you can take the higher one. And if the higher is a negative -1, you ignore the sign.
And the 12.5 is the norm. Like anyway, you have to put
No,
12.5.
12.5 is the capital, no, the total capital ratio of your bank. Now, if it's
Okay.
a DC bank, your minimum ratio is 14%. Then you need to apply 14.
Okay.
Right now, this example I have taken a normal bank.
Okay.
So if it's a DSIB, instead of 12.5, you need to apply 14%.
But currently there are only 4 banks coming under that category.
Yeah,
Yes.
yeah, only 4 banks. Yes. All others are 12.5.
Yes, thanks.
Any other question? And if you don't understand, you don't worry, you can ignore this.
So in the previous slide,
Sorry?
So in the previous slide, how we calculate that risk-weighted asset for the market risk, that is 2.09 million.
This one. Now, so far what I have thought is the capital charge for market risk, right? Capital charge. Now, of course, if you want to see the formula of computing this, I hope you can read this, right? This formula. Now it's clear, right? Hello?
Yes, sir.
Clear,
It's
right?
clear. Yeah.
Now, this formula, we are comparing the capital with risk-weighted assets, not with the capital charge, right? So, technically, what we have to do is, once you computed the capital charge, we need to convert that capital charge into risk-weighted assets. Right? So this is our capital charge. Okay. then we need to convert this capital charge into risk-weighted assets by multiplying the capital charge with the reciprocal of your capital ratio. So reciprocal means 1 over 12.5 or 1 over 14 for a DC. Okay, into 100. So this is the reciprocal. So by multiplying the capital charge with the reciprocal of your minimum capital ratio, you get the market risk, the risk-weighted assets for market risk. Okay.
Okay.
Okay. So if you don't understand, nothing to worry. Because now this computation is a automated part in the return. Once you put the capital charge, the rest of it is automatically computed by the return. So that return is somewhat automated. So all the formulas and things are auto-fill. So banks not required to fill that. You need to fill only your computation. Right? So once you put the risk capital charge, the rest of the part is auto-filled by the return. Okay. And conceptually, in order now, the formula is comparing your risk-weighted assets with capital. Therefore, all the capital charge, even you take credit risk or operational risk, first you need to compute the capital charge. Then the formula is already put in, and for each capital charge is converted into risk-weighted assets by multiplying the reciprocal of your total capital ratio. So reciprocal means 1 over anything, right?
So here the applicable regulation is issued on in 2016, the number 1 of 2016.
Capital adequacy ratio, Basel III capital adequacy.
Thanks.
Right? Okay. So any other questions?
So one question, this is related to the borrowing of the licensed commercial banks. Then again has the borrowing of the licensed commercial banks.
Okay.
Then has the regulator imposed any regulation on that?
Yeah.
Because I am not working in a bank, that's why I am asking.
Yeah, there is foreign currency. You are talking about foreign currency borrowings, no?
Oh, no, I am not asking the foreign currency, I am asking the local currency.
Okay, there is a regulation on maximum amount of accommodation. Still, I'm not clear. Still not clear. You're talking about bank borrowing, or it's the borrowing of the customers?
I am talking about the borrowing of the bank.
Banks borrow from somebody else in rupees.
Yeah.
For that, no limit. For local borrowings by bank, no limit, but for foreign currency borrowing, there is a limit.
That is maximum amount of accommodation will applicable only for foreign currency borrowing, is it?
No. Maximum amount of accommodation is applicable for when a bank give loans to others.
Okay.
Right? And foreign currency borrowing, there is a separate regulation which I covered in my first class. This is the regulation. Foreign currency borrowing limit. This is in your handout. I covered that in my first class, and this is the short-term limit and the total borrowing limit. This is for foreign currency borrowing by bank.
Okay.
Borrowing by bank, there is no limit. Lending by bank give loans to customer. There is again there is a limit called maximum amount of accommodation.
Okay.
No? So this you can read and understand.
So whenever bank has breached some regulatory requirement, then can the regulator impose on certain cap on new borrowing?
Foreign currency borrowing?
No, again local currency. Breach some regulatory requirement, Then can the regulator impose any cap or any restriction on that new borrowing?
Yeah. I think when a bank violates regulation, there are so many regulatory intervention or regulatory powers we have, and
I see.
central bank has, right? Some of them are restriction on it could be borrowing, it could be lending, it could be recruitment, it could be branch expansion, business expansion, anything. Bonus payments, dividend payments, anything we can impose when a bank violates a regulation. So depending on the severity of violation, and there are so many other factors we need to check. Depending on that, regulator can put any kind of restriction to a bank. Right? We can stop bank borrowing locally, bank borrowing outside the country, bank granting loans within Sri Lanka or outside Sri Lanka. We can stop the recruitments made by banks, bonuses paid to the CEO and KMPs, and there are so many regulatory powers we have that we can implement in the case of a non-compliance by bank, and we have done that in the past. So many times we have done that. And last year there was one case, one CEO, not last year, 2018, his bonus was curtailed. We did not permit the CEO to take any bonus. And there were so many cases where we declined branch expansion because of non-compliance. We declined borrowings, we declined investments, and we have declined loans to OBU customers, offshore banking unit customers, and we have stopped recruitments. So there are so many regulatory intervention powers we have, our central bank has. So depending on the severity of the non-compliance, can be done. The lowest is a reprimand letter. So at least we can send a letter to that person saying that, he is not, how to say that. And central bank has some concern on the activities of that person. So we can send a reprimand letter, we can call for explanation, can call a particular officer to central bank asking for explanation. So that is the lowest level of regulatory intervention we have. So it can increase up to stopping anything. Okay. Okay, I think, yeah, any question?
So what are the common errors made by the banks when it comes to market risk computation?
Computation?
Yeah, this was a little while ago we did the calculation on this market risk capital charge. What are the common errors done by banks like?
Okay.
Is it?
So difficult to give an answer for this. Now, for say, of course, now I don't think any bank making big mistakes, because this direction is there for last 20 years. Right? Okay. Even the Basel III we issued in 2016, this Basel framework is there since I think maybe from 2000, yeah, 20 years it is there. So gradually we have rectified the mistakes what the bank have been doing, right? So now I don't think there is big mistake. Say now throughout the period, right? And it's not that mean now banks are making this mistake, but in the past at a point these mistakes were identified, right? Don't think that the mistakes I'm telling is the mistakes the banks are doing now. It's not the case, right? So over a period, banks have improved all their mistakes. At the beginning, the problem we had is most of our bank did not have a value at risk computation model. Therefore, these mark-to-market values were basically computed on Excel sheet using Excel formula. At that time, the main problem is getting the mark-to-market rate, right? It's not up to date. There were cases where bank have used a previous rate, 1 month before rate, 1 week before rate, right? So that initially we need to rectify. Then similarly, with regard to, again, the interest related instruments, there were some mistakes in identifying the ratings. Now, I said those interest rate related specific risk depends on the external ratings, right? So again, the ratings were not updated. Now, whenever the rating agency go and change the rating, the bank need to update. Now, even now, your bank, your system should have updated the Sri Lanka country rating or downgraded to CCC. Accordingly, you need to upgrade your system with the new rating. But I hope now banks have the system. But think of 5 years, 10 years down the line, there was some issue in updating the rating. Therefore, they used the wrong rating in computation. That we need to adjust. So basically, the mark-to-market computations are not correct because of the either they were not taking the latest market rates available or yield rate available in the market, and they were not taking the latest rating available in the market for different corporates and different sovereigns. Of course, sovereign only few banks, but when it comes to corporate debentures, sometimes the treasurers are not know. They don't know the rating has been changed, right? So those things were there, but then again, once you computed, if you are doing in an Excel sheet, you treasurer need to compute the mark-to-market value, and somebody else need to check that. We call validation process. That validation process were not up to the mark. I mean, nobody is doing a validation. It is done by the treasurer, checked by the treasurer. There's no segregation on validation. And in most of our banks at that time, there was no middle office, only front office and back office. So those the validation part has to be done by the middle. Now I think major banks have that middle office now. So the validations are not done properly. So these were the mistakes we came across through the last 10-15 years. But now, of course, I can't think of mainly now. I think at least the major 8 dealing banks, they have automated system, automated treasury modules, and they have some kind of value at risk modules in place. So the mark-to-markets are up to date. And now they have this Bloomberg or Reuters platforms. So therefore, it's easy to get the mark-to-market rate and the exchange rate on real time. So again, the system automatically picks up from the trading platforms. So that issue also now, it's very less. Of course, I'm not visiting the bank. I'm not in on-site division for last 10 years. So I can't, give you 100% accurate answer. So, but compared to 10 years back, now our banks and system have improved. Now bank have middle office. So that validation part happens more frequently. And on top of middle office, then risk management department and compliance department also active now. If you take 10 years back, nobody respect the compliance officer. If you just ask your senior people in your bank, they don't care the compliance. Compliance is just a small unit partitioned by, it's less than a 10 by 10 feet unit room. So it's a partition with 1 manager and 2 assistants, that's all. So now compliance is a very recognized, very status job in a bank. So the DGM level appointments are there, it's a big department. So now they also come and check these things. So now I think banks have done a lot of progress in rectifying these mistakes. And every time whenever the central bank on-site examination go, we check the computation. If there is any mistake, they also rectified. So as of now, I can't think of a major mistakes done by banks because of automated system, because of middle office, and because of strengthened risk management and compliance function. But still, there could be some mistakes. So,
Thanks.
Small question.
yeah.
So with all these regulatory framework and central bank supervision, Pramukha Bank failed. Could you explain how exactly it happened?
Yeah. Again, Pramukha Bank, it's not a failure, right? It's a bank closure by the regulator because of mismanagement. So it's not a bank failure. There is a big difference between a failure and a closure by the regulator, right? And the other thing is the Pramukha Bank case happened in when it was happened? 1990s, ne?
Yes,
So,
it's before 2000.
Yeah, we'll say 2000. Now, 20 years back, we did not have a stringent regulatory framework, right? And the other thing is, even though you have the best regulation in your country, there's no guarantee that no bank will fail. There's no guarantee for zero failure. Even you take the developed countries, you take US, you take UK, any country, there is now, if you take US, even last year, there were more than 1,000 banks failed, right? So there is no guarantee for zero failure because it's a cycle. Crisis anyway comes. You do whatever things, the crisis will come. You can't stop crisis, you can't eliminate crisis. Therefore, bank will fail even in the future and no guarantee for zero failure. And the other thing is, if you go to my this research done by Coty, I've given few slides, right? How the 2008 global financial crisis happened. The researchers done some research, and one of their finding is the banks are smart because they always come up with innovative way of doing business, innovative way of overcoming regulation. You put one regulation, after 1 month, the bankers will come up with a innovative kind of, escaping some regulation. So that is how the banking industry is evolving. Any industry is evolving. So if you talk only about the Pramukha case, 20 years back, we did not have a stringent regulatory framework like what we have today. And it is not a bank failure, but it's a closure by the regulator. And the third point is there's no guarantee for zero failure, right?
Thank you.
Sir, this value at risk is nothing to do with this thing, no? Like, is it separately computed by market risk?
For market risk, what is the software you are using?
The value at risk computation is it different from completely different from the capital charge? Is it?
Yeah, capital. Yeah, it is different because capital charge is anyway a manual work, but you get the base data from the VAR model.
Okay.
Right. So this computation, there are a lot of manual intervention.
Yeah.
So with the sophisticated models, you can't prepare this return. So remember, any return you can't do that. So there are 28 regulatory returns. So none of even your balance sheet, you can't take from your system. Now these regulatory returns, there are manual intervention, but the base computation is given by the system. So by taking the base computation, again, you have to manually do some workings and input the data into this return. Okay.
Okay, sir. In this series, we didn't talk about value at risk, no, sir? Like how computed. this value adds risk computation and all, we doesn't talk on this lecture series.
Not from my class because my topic is different, but I hope in your treasury other modules it should be covered, I think, or if not, maybe in the next classes.
Okay, thanks.
All the treasury related models, there are few models, value at risk and present value basis points. There are some models. The yield, there's a different model for yield computations. Now, how many more months you have to complete this course?
No, immediately after your this thing, I think this course is over. It seems there are only 4 revision classes.
So in that case, it should have been covered now.
Yeah, maybe yes.
Yeah. Okay.
Thanks.
Okay, so we can have a break for 15 minutes. We'll come at 10:45 and try to finish the remaining slides. Can we start the class?
Yes, I will start.
Yeah, okay, so we will start. Then Videsh Shilva. Videsh Shilva asked a question in the chat box. Videsh, hope you are online at the moment. Yeah, so he is asking what are the things ALCO is considering to do when they categorize the investments into trading, HTM and AFS. That is basically a business call for the bank. It depends on number of factors. The basic factor where the decision to whether to put it in the trading or AFS or HTM is the expected movement in the yield rate. Right now, every people they need to forecast. Yeah? So treasury is basically on forecasting. So you need to, what is your expectation on future interest rate movement, future yield rate movement, and so that expectation is the base for this classification. So basically, ALCO might have an expected view on the future interest rates. So depending on that, they might decide, depending on their view on the future interest rate, which category this should be put. The other thing is the risk appetite of the bank. Now, some bank, they might think that, okay, don't want to put it in the trading. We don't want to take the mark-to-market hit on our book, right? We are a small bank and we don't have an active treasury and we don't have specialists to forecast the future trends and movements. So that kind of a bank may think, okay, it's better to keep most of our portfolio in the HTM, that is the risk appetite, right? And some bank, the active treasury with models, sophisticated tools and forecasting statistic, Reuters platform and all, they might think, okay, we have the capacity, we are capable of forecasting and analyzing the market trend. Therefore, we may put our most of our things in trading, and we try to get a trading gain on the portfolio. So the risk appetite will be the second reason. The third reason is risk diversification policy. Now, whether you are a good bank or a bad bank, or good bank or a not so good bank, you have an active treasury, you have all the system, but still risk diversification is important. So that is basis of basic risk management thing. So based on that, the ALCO might decide, okay, how to diversify risk on this portfolio. So if you keep everything in your HTM, again, there could be huge risk. If you keep everything in your trading, again, you are exposed to mark-to-market losses. So for diversification of risk, again, people divide this into different buckets. Right? So those are the basic factor that determine to which category this should be. The other thing may be some regulatory requirement. Now, say for example, if you are more active on primary dealing or repo borrowings, then you might put it under HTM. Because now, if you have a trading, then that is mostly for buying and selling. So if you want to do a repo borrowing, then you need to have some long-term instruments. So in that case, if you are highly dependent on repo borrowing, you might have your investment in the HTM book. The other thing is what else? I remember one more point, but now forget. No, can't recall. But those are the things when the ALCO should look into when they are going to classify these instruments. Right. Other thing is regulatory requirement, I said. So the bank need to maintain your liquidity ratio. We will discuss that in a minute. So SLAR, statutory liquid asset ratio. One of the main instruments to meet that liquidity requirement is government securities. So to meet that, then there is LCR, liquidity coverage ratio. So to meet those requirements, bank might need to keep some HTM instruments with them. So those are the factors basically, determine the amount of your interest-related instrument, whether to put it in trading book, HTM or no, AFS. Okay. Any question, Videsh? Are you clear? Okay. So he is clear. So we can move on to liquidity risk management. So basically, liquidity is the ability to convert your assets into cash, but without causing a significant value loss or movement in price. So those two you are important. Technically, you can convert any assets into cash, but the problem is how quick you can convert and how much you need to lose for converting that asset. Those two factors determine whether that asset is a liquid asset or a non-liquid asset or illiquid assets, right? And that is liquidity, the ability to convert your assets into cash within a shorter period and also with a minimum value loss. Then liquidity risk is where a bank or anybody failing to meet their day-to-day obligation. It is your inability, bank's inability to meet the day-to-day obligation. It may be depositors or it may be other creditors. Because people who deposited money, they want to withdraw. And other creditors, so people who give you money, borrowed you or lent you money, they also may want to take out money, right? So when a bank failed to meet the demand of depositors or creditors, that creates a kind of a reputation risk to the bank. So then message, now these days within 5 minutes you put a post in the Facebook, then finished, right? So now these days the sensitivity is so high, so it may lead to a significant reputation risk to the bank. Once that reputation is in danger, what happens is everybody wants to take out your money, to take out their money in your bank. Then we know banks are naturally, they have a maturity mismatch risk, because you take deposit for a shorter period, maximum 1 year or 2 years, or on the extreme case maybe 5 years, but you give loan with a longer tenor, starting with 3 years, 5 years, 10 years, 20 years, 30 years, like that. So inherently, the banking business model is exposed to liquidity risk because of this mismatch. If all the people comes and ask you money today, you can't recover your loan today to pay them. Then naturally bank will be falling into trouble, and it may ultimately lead to a run on the bank, right? So run on the bank, then it will make the bank failure. So liquidity risk is the most severest risk in the banking business. So it may come from anywhere. It may come from a reputational issue, it may come from a technical fault, or it may come from a fraud or hacking or cyber threat or whatever. It may come from mismanagement, it may come from your credit becoming NPL. So liquidity is not a single kind of risk, right? Anything that happens in a bank ultimately end up with a liquidity risk, liquidity crisis. Therefore, banks are required to manage this liquidity risk on a dynamic basis, not like credit. So you can give a credit and wait for 3 months. If you not fail, you put it in NPL. Then you make provision. Then wait for 1 year, 2 year, 3 year. Still not paid. You go to the courts and recover the property, right? But liquidity risk you can't wait like that. So it's more severe and most dynamic. Then bank also need to act very quickly. You have a very shorter time to react. Right? So managing liquidity risk is very important. Now, how to manage liquidity risk? So that is the next question. Now, if you want to manage liquidity risk, that means you need to keep liquid assets. Now, if you keep all your deposits with you without lending or investing, there's no liquidity risk. So whenever people come, you can give money. But if you keep all the deposit with you, you can't earn profit. When you want to earn profit, you need to invest and lend. When you do that, you are short of liquidity. Therefore, managing liquidity risk is kind of a break-even between a profit making and a banking failure, right? So you need to make profit. At the same time, you need to keep a minimum amount of whatever the minimum requirement of liquid assets. So therefore, keeping cash alone will not enable the bank to make profit. And considering that the regulation has defined certain assets as liquid assets. For example, government securities, treasury bills, bonds, and sovereign bonds. And also tradable securities like debentures, commercial papers, short-term papers, interbank placements, right? So those are considered as liquid assets. Therefore, a bank can manage its liquidity crisis or liquidity requirements, and at the same time, bank can make a profit. Right? So it's a kind of a break-even between profit making and liquidity. So a bank's internal policies may have so many requirements to manage your liquidity. You might have a mismatch gap analysis and interest rate sensitivity and measurement. So and also ALCO requirements, and there could be many liquidity related internal policies or internal measures you can have in your bank. But as a regulation, there are two main regulations that focus on managing the liquidity risk in bank. So one is the statutory liquid asset ratio. Short form is SLAR. Now this is a kind of stock approach, right? So this is a kind of stock approach. Now, when I say a stock approach, that means bank will have certain amount of liquid stocks, liquid assets to manage your liquidity requirement, to day-to-day liquidity requirement, right? So that means you have this amount of liquidity assets or liquid assets to manage your day-to-day requirement. So requirements come from your liability side. Your depositors may need money. Your other creditors may need money. So it comes from your liability side. And assets are from your liquid assets come from your asset side. You have cash, you have treasury bills, bonds, and you have corporate bonds, you have interbank placements. So those are assets. So simply the regulation says a bank should have minimum 20% of their assets in the form of liquid assets, right? Oh, sorry. A bank should have a minimum amount of assets in the form of liquid asset that is enough to cover 20% of your liability, right? So you should have minimum 20% of liquid assets or minimum amount of liquid assets that is equal to 20% of your liabilities. So that's how this ratio is computed, right? So if you say this is your total liabilities, this is your total liability, and you have this much of liquid assets. So therefore, this much of liquid asset should be minimum 20% of your total liability, right? So that is the regulation. Okay, so you should have a minimum liquid asset that is equal to 20% of your liability, right? So when I say liability, that is only liability without equities. Shareholders funds are taken out, so that those are equity. Without that, right? So liability means your depositors and other creditors, right? And the direction has specified what are the acceptable liquid assets for this computation. So I have already discussed that includes the cash balance, interbank placements, balances with central bank, treasury bills and bonds, and ISBs or government securities, and tradable corporate debt securities, right? So these are the liquid assets defined by the regulation, right? So out of that asset, out of that liquid asset, you should have enough assets to cover at least 20% of your liabilities. Then this 20% is defined by the regulation, and it's come from the Banking Act. Okay, so it's actually not a direction, it's a Banking Act provision. So the Banking Act says the Monetary Board of the Central Bank can define a minimum liquid asset ratio between 20% to 40%. So maximum central bank can impose 40% of liquid assets, minimum 20%, right? So at the moment, the Central Bank of Sri Lanka, the Monetary Board has decided the minimum should be 20% of your liability, right? But remember, anytime central bank can increase this 20% up to 40%. Beyond 40, they can't do, right? So 20 to 40, central bank can impose liquidity ratio, minimum liquidity requirement anytime, right? The other thing is, since this is coming from an act, this is coming from the Banking Act, the bank, whenever they non-comply, whenever they breach or whenever they fail to maintain minimum 20%, there is a penalty. If it's a direction, there's no monetary penalty at the moment. No, for Sri Lanka, we don't have a monetary penalty for violating a direction. We have other kind of penalties that just I explained in the morning, right? A restriction on many things. So those are other kind of penalty, non-monetary penalties. But monetary penalty we don't have for violation of directions. But violation of act, there is a penalty. If you take any act You violate Traffic Control Act, there is a penalty, monetary penalty. You violate your Inland Revenue Act, there is a monetary penalty. Violate your the FTRA Act, there is a penalty. And violate the AMLCFT Act, there is a penalty. And similarly, when you violate this SLAR, there is a penalty, right? So the other thing is this minimum 20% is on a daily basis. So every day you have to have minimum 20%. It's not on month end. Even though the reporting to central bank happens on a monthly basis, so every month end you report to the central bank, the requirement is on daily basis, right? So every day you have to have this 20% minimum. Now during our on-site, people go and check, they ask for the daily worksheet. So they check every day by day, whether the bank is having 20% or not. Now, if you fail to pay or fail to maintain 20% today, whatever the shortfall, say minimum you should have 300 million liquid asset, but you have only 290 million liquid asset today. So 10 million liquid asset shortfall. They put 0.1% penalty per day on the shortfall. So 10 million into 1% into 1 day. If it's 7 days, 10 million into 1% into 7 days. Like that. So per day, there's a 0.1% penalty on the shortfall, right? And again, there's another important thing in the regulation. I think I told you in my first class, in a bank, there are 2 units. You take a commercial bank, licensed commercial bank, they have 2 units. One is the domestic banking unit, and the other one is a foreign currency banking unit, right? So domestic banking unit, basically, they do business in rupees. And foreign currency banking unit, they do business in foreign currencies. Now this 20% is not for the bank, remember. And this 20% is separately for DBU and separately for OBU or FCBU, right? For DBU, out of your DBU balance sheet, you should have 20% to cover 20% of your liability. Out of your foreign currency balance sheet, you should have 20% of liquid asset to cover 20% of your liability, right? Now, say for example, a DBU, you have only 18%, right? DBU, you have only 18%. Your SLAR today is 18%. In FCBU, you have 22%, right? Then you can use that 2% excess in OBU or FCBU to cover up the shortfall in DBU. So now, when you add together 22 plus 18, 40. So that is there, right? So by using the excess liquid as stock in the FCBU, you can cover up the shortfall in the DBU. That is permitted. And take another example. Now today, your SLAR for DBU is 22% and FCBU is 18%. Now what is the position? Can you cover up your excess in DBU, that 2% to cover up the shortfall in the foreign currency banking unit? Can you do that? What is your opinion? If not, what could be the reason? If yes, what is the reason? Anyone? Okay, so I'll give you the answer. Everybody's keeping silent. I hope you are back after the break. Right? Now, direction says DBU excess cannot be utilized to cover up shortfall in FCBU. Right? But you can use FCBU excess to cover DBU shortfall. and not DBU excess to cover HCBU. So that is not permitted. It's only one-way traffic. Now the reason is, for DBU is a rupee balance sheet. So rupee is not a hard currency. You can't buy liquidity with rupees. But if you have dollar or GBP or euro, those are hard currencies. You can buy liquidity in the international market, right? If you have foreign bonds, you can go to foreign market and get repo facility, right? So foreign currency, basically the major foreign currencies are dollars, pound, euro, and yen. We forgot about yen even. So we can say dollar, euro, and pound. So from that, you can cover up, you can bring LKR liquidity. You can cover up LKR liquidity. Now, say for example, if one of your depositors is coming to withdraw money, you say, okay, today I don't have rupees. All my rupees are finished. I have dollar. Can I give you in dollars? He is more than willing to take that, right? Then say you have a foreigner, say American guy. He's having an account in dollar. Now he come to your bank for withdrawal. You say, okay, today I don't have dollars. Can I give you rupees? Will he accept that? No. So that is the reason why we say you can cover the excess shortfall in DBU with excess in FCBO, but you can't do other way around because rupee is not a hard currency and not a internationally accepted currency, right? So those are the major requirements of the direction, SLAR direction. But any clarification you need on SLAR? I think I have covered, even though it's nothing written here, I covered the entire direction. So any question on that? Any clarification you need?
So when did this SLR regulation issue, that is also coming issued on 2016?
I can't hear you. Can you repeat it, please?
The SLAR regulation, it was issued on 2016 itself or recently?
No, this is there for maybe 20, 30, 40 years. Because it's coming from the Banking Act now.
Okay.
So it is there from the Banking Act, the date of the Banking Act. So this is not a new thing. But from the beginning, this requirement is there. Right?
Okay. And DBU, FCBU, DBU and FCBU both, we have to calculate the SLAR.
SLAR separately, 20% for DBU, 20% for FCBU. Right? But now the latest development with regard to SLAR is after COVID, central bank has given permission to consider certain assets as liquid assets. Right? Anybody aware of that? What kind of assets we have permitted to consider as liquid asset? I said according to the direction, cash, interbank placements, government securities, tradable corporate securities are there already. So on top of that, due to the COVID problem, in order to make the bank liquid, we permitted certain other assets to be considered as liquid assets. So what are those assets? Any idea?
Government overdrafts?
Yeah, overdraft to the government, yes. So we permitted the bank to consider the overdraft balances in People's Bank and Bank of Ceylon, where the government treasury has maintained a current account. And of course, that is applicable only for BOC and People's Bank, where the treasury, the government treasury has a current account, so they can overdraw. And every time it is overdrawn, right? So that overdrawn balance of the government, the People's Bank and Bank of Ceylon can consider them as a liquid asset subject to a haircut. So there is a haircut subject to that they can consider. Then we permitted the banks or to any bank, right, to consider loans given to the government or government sector enterprise, SOEs, state-owned enterprises, which is guaranteed by the government. Right? You may given a loan to the government, or you may given a loan to a corporate, this state-owned enterprise like petroleum corporation, water board, electricity board, like that. So state-owned enterprises, bank has given a loan, but that is guaranteed by the treasury, by the government. So that loan, again, you can take up to 20%. Right? 20% of that loan is considered as liquid assets. Then government, sorry. For the government contractors, the government, they put road, they build bridges and all sort of buildings for the government institution. That those contractors, they take loan from bank and they build the project, and after completing or in between, the government pay little by little, right? But as of a date, there is some pending due from the government. So today, if you take, for example, today 20 million, only an example, the government need to pay 20 million to MAGA or maybe Sierra for the construction work. And that due, what they did is they are, you know what the position of our government, they don't have money. They simply say, okay, we give you a letter of undertaking, right? We give you a letter saying that government owes 20 million to MAGA, right? So that letter of undertaking, MAGA can take that letter to a bank, produce that letter, and take a loan, right? So that loan, or up to the value of the letter of undertaking, is considered as liquid assets, right? What is your personal view on this? Is it a good thing or a bad thing? So do you think that whatever the assets I just explained you is provide any liquidity to the bank? What is your opinion? Don't worry about the government or the central. There's nothing politically related here. It's only for study purpose. So don't worry about blaming the government or blaming the central bank or whatever. It's an open view, only for education purpose. You can forget that after this class.
So this is a very special situation. So in that situation, now under normal circumstances, this money would have been in the bank. Because of special thing, it is not there. So I think it will be a temporary measure until the things are sorted out. From technical point of view, it may not be a very prudent thing, but under the circumstances, yes, I think there is something good to do.
Right. Yeah, if you see the technicality of those assets, those are actually illiquid assets, right? So those are not liquid assets, so it will not provide any liquidity to the bank. But again, considering the current situation, and theoretically, those are liquid assets. Because, you know, the government is anyway responsible to look after the banking sector, right? So if say for example, because of liquidity crisis, one bank is going to fail, then immediately government need to pay whatever the dues. So whatever the payment due from the government to that bank, they have to pay. So theoretically, those are there is some liquid nature, right? So theoretically, those are liquid assets, but in practice, those are not liquid assets. But as you said, considering the crisis situation, and considering the undertaking given by the government, so there is an undertaking, there is a guarantee, right? If there's no guarantee given to a loan provided to, say for example, CPC, that loan is not considered, right? But only if there's a government guarantee or a government undertaking, it has been considered as a liquid asset. Anyway, overdraft is on demand thing. If the bank wanted money today, government need to pay today because overdraft is on demand. So theoretically, those are liquid assets. So that's why we permitted considering the exceptional circumstances. But those things are not like the real liquid assets. So we need to understand the difference, right? So, but anyway, since theoretically those assets are liquid assets, we have permitted them to take that. But again, that is for a shorter period. So every day they can consider that as liquid assets. Okay, so that is on SLAR. Now we move to the second kind of regulation on liquidity. Now this is actually coming from the Basel III framework, and it is implemented in 2015. So as I said last week, after 2008 financial crisis, regulators all over the world and also the Basel Committee realized that bank need to manage liquidity, right? Bank need to manage liquidity. So therefore, they brought up a framework based on a flow approach. Now this SLAR, I said stock approach, where we check only how much of liquid asset you have. You have 20% of liability, that is fine. So that's it. But LCR is a flow approach kind of a framework. The problem with stock approach is, okay, you can say that, okay, today I have 20 million liquid asset with me. I have 20 million treasury bill with me. Or I have 20 million cash with me. But one depositor may be more than 20 million, right? So again, the stock is not adequately manage your liquidity position. It's just an indication, right? It's not the real-time flow. So today, how many withdrawal comes, nobody can tell, right? So if the withdrawal comes today more than 20 million, you are keeping only 20 million assets, so you are in liquidity problem. So SLAR or the stock approach is kind of an indication of liquidity, not the real measure of liquidity. But the flow approach is a real measure of liquidity. The Basel framework adopted that. Now the concept is somewhat similar, right? Now here again you need to compute how much of liquid stock you have. Similarly, or similar to SLAR, here also you need to compute how much of liquid assets you have. Again, the considered liquid assets are almost same. Cash considered, government securities with a tradable market is considered, right? Then corporate securities with tradable market again considered, okay? And that liquid stock is divided into tiers. Now cash is a tier 1 or high quality liquid asset. We say that level A. Government securities are level 2A. Corporate securities are level 3A. Oh, sorry, level 2B. So there are only 3 levels: level 1 assets, level 2 assets, level 2A assets, and level 2B assets, right? So under SLAR, there's no such categorization of asset based on the quality of asset. Here everything is same, and there is no haircut for that. But under LCR, cash and placements with bank are considered as level 1, no haircut. Government securities with a tradable market considered as level 2A asset with 20% haircut. And other corporate debt securities with a tradable market considered as level 2B with a 50% haircut, right? And can you tell me, no, I will give the answer. So I said government security with a tradable market. Now SLDB it's not a tradable instrument. We don't have a market. It's not listed. Therefore, even though SLDB is a government instrument, which is not a liquid asset for LCR computation, but it is a liquid asset for SLAR computation, right? For LCR, the Basel framework says whatever the instrument you are taking, it should have an active trading market, right? Active trading secondary market. For SLDB, we don't have a secondary trading market. It's not active. Even sometimes you may have a market, but it's not active. So then still you can't take, right? So anyway, the concept is same. Bank need to compute your availability of liquid stocks divided into 3 different categories with haircut. Then under SLAR, you compute your liability, right? But under LCR, you need to compute your cash inflow and outflow. Okay. You separately compute your inflows for the next 30 days and you compute your outflow for the next 30 days. So it's a futuristic thing. SLAR, stock is as at a date. On a particular given day, how much of stock you have. But LCR says for the next 30 days, what is your inflow and what is your outflow. So it's a forward-looking approach. Then after computing your inflow and outflow, we know how much of net outflow. The outflows are more than inflow. You can compute what is the net outflow. Now, if you see this example, now this is your total outflow and this is your inflow. So your net outflow is this much, right? So outflow minus inflow is the net outflow. Now, whatever the liquid asset you have should be equal to cover the net outflow. That is 100% coverage. So LCR is 100% coverage of your net outflow during the next 30 days. Okay. So if your net outflow is 1 million for the next 30 days, you have to have minimum 1 million high quality liquid asset. If your net outflow then for the next 30 days is 10 million, you should have minimum 10 million liquid stocks. Okay, so it's a flow approach, forward-looking approach, and the coverage is 100%. SLAR is a stock approach, asset date approach, and you see how much of stock you have. That's all. Right? So LCR, is that clear now? Any question on LCR?
Can you explain it again, sir? That's once again.
Computation part. LCR, no?
Yeah, LCR. Yeah.
Okay. Can I use the board?
Sorry. Yes. You can use the board. Yeah.
Okay. Okay. Now, say for example, today you are going to compute your LCR. So first of all, bank need to compute what is the high quality liquid assets the bank is having in that reporting day. So these high quality liquid assets are divided into 3. So level 1 assets and level 2A, level 2B. Right. So the liquid assets are categorized into 3 categories: level 1A, level 1, level 2A, and level 2B. So basically, level 1 include your cash balance, and interbank placements. Right? Interbank placements. And for level 1, these are pure form of liquidity. Right? This is pure liquidity, therefore no haircut. Right? Say for example, you have cash of 5 million, this is in millions, and the interbank placements of 20 million. Right? Then level 2 assets are basically government securities, and again it should have an active trading market. If there's no secondary market for a government instrument, you can't consider as level 2 asset. So it's not a liquid asset. Now, for example, SLDB. SLDB in Sri Lanka, we don't have a secondary market, active market. So it's only with the central bank, there's no secondary market. Therefore, for LCR computation, SLDB, Sri Lanka development bonds, are not considered as liquid asset. But for SLAR, yes. Right? For LCR, no. Right? So we'll take other examples, treasury bills and bonds. So those are level 2 assets. Right? So you have treasury bills and bonds. $500 million. Right? You have treasury bills and bonds 500 million. But the direction says this 500 million is not your liquid asset. There is a haircut of 20%. So level 2 assets are subject to 20% haircut. Right? But remember, these haircuts are only, I'm taking an example. Depending on the type of instrument, there are different haircuts. Right? So, but the computation is same, the concept is same. I'm taking only one example, right? If you go, there are so many other haircuts for level 2A and level 2B, right? Depending on the instrument and the rating. If a AAA corporate bond is considered as a 2A assets, right? But double B or triple B minus bond is considered as triple B. So depending on the rating, haircuts are different, right? But this is only an example. And anyway, I'm not going to teach you the entire LCR direction, no, because this course is not for that. The only thing is you need to understand the concept behind this, right? So level 2 asset says, so 2A, there is a 20% haircut. So then how much of amount you can take here? You have 500 million treasury bill, but there is a 20% haircut. Then how much you can take? Only 80%.
400.
400. Right? And similarly, we take a corporate bond, right? Corporate bond. So again, corporate bond that should be listed in a stock market, and there should be a secondary market. Otherwise, you can't take. So for LCR, that is the basic requirement. There should be an active trading, secondary trading market for that. Otherwise, that instrument is not considered as a liquid asset. Even you might have a AAA rating, but if it's not listed or there's no active market, you can't consider. Right? So for this, there's a 50% haircut. Say you have a corporate bond of 100 million. So how much is your liquid assets now? Only 50 million. Right? Okay, so you have already this stock with you. Right? So then this is your HQLA, high quality liquid assets for LCR computation. So 450, 475, right? 475. So the next thing is bank need to compute your cash inflows and outflows for the next 30 days. So it's a forward-looking thing. So now you are going to compute your inflows. right? So how the money come into the bank? What are the inflows to the bank?
Customer deposits.
Yes, deposits.
Loan
Deposits.
deposit, loan repayment.
Loan repayments. And maturing investments. Right? Anything else? So you need to see, you need to check your balance sheet and take all your inflows. Right? Again, deposits. It could be a FD, it could be savings deposit, or it could be current deposit. If it's an FD, there's a haircut, right? And savings deposits, it's treated separately. So again, loan repayment, you can take only the loan repayment that will come to your bank within next 30 days, right? So beyond that, you can't take, right? So, okay. So by computing all your inflows, subject to whatever the haircut given by the regulation, so you have a total inflow for the next 30 days is 700 million, right? 700 million. Similarly, you need to check your outflows. So what are the outflows for the bank? Major outflows. Loan disbursement, withdrawals, deposit withdrawals, and investments. So if you invest in treasury bill, money go out of the bank. You invest in stock market, money go out of the bank. So there could be other outflows. You need to check your balance sheet. And again, you compute all your outflows for the next 30 days.
So application of haircuts, will that be same for inflow and outflow with the same treatment?
No,
different treatment?
no. Inflow has a different kind of haircut. Outflows, they have a different kind of haircut. And within the inflow, depending on the instrument, haircut differs. Within the outflow, depending on the instrument, haircut differs. So there are different, for each and every line item, the regulation gives you what is the haircut, right?
Okay, sir. Okay.
It's not easy as I explained, so it's very complicated computation. So remember, for each item, each type, for all the items in your balance sheet, the regulation gives you the haircut. So if you take LCs, derivatives, so everything there is a haircut, and the mechanism is given in the regulation. So, and I don't want to make that much of complicated this. So simply, this is how it happens. Let's say you computed your outflow, and your outflow is 1,100, right? So for a bank, generally outflows are more than inflows, right? So because of the maturity mismatch. So your loan disbursements are in big amounts, and loan repayments are small amount. Your loans are more than your deposits. So therefore, naturally for a bank, if you take 1 month or any given period, inflows are less than your outflows are more, right? So that is where the maturity mismatch is coming. So that is natural for a banking business. Now, we need to compute what is our net outflow. What is the net outflow for the next 30 days? So, outflow minus inflow. So it comes to 400, right? So your net outflow for the next 30 days is 400. Right? Now the regulation says you should have 100% coverage. Minimum 100% coverage. So that means you have to have minimum 400 million liquid assets. Okay. Now, how much you have? 475. So that means your coverage is more than 100%. You are okay. Now, instead, say you are complying with the regulation. Say your net outflow is, I will put this 1,300. How much then? 600. So your net outflow is 600, but you have only 475. So you are not having 100% coverage ratio. Therefore, you are not complying with the regulation. Is that clear now?
Yes, sir.
Okay. So those are the two regulations related to LC, liquidity risk management in bank. And the latest one we introduced is NSFR, that again coming from the Basel III framework. So if anyway, we'll ignore that. It make the thing more complicated. But the main difference between LCR and NSFR is LCR forecast your liquidity requirement for the next 30 days, and NSFR forecast your liquidity requirement for a longer period, so more than 30 days, right? But we'll ignore that, it's not required anyway. Then the other regulation is on asset classification or loan classification, right? So this is where the loan portfolio are categorized into NPL, and the related provisions are made. So when a bank gives loan, it expects people to pay back, right? If the people have failed to pay back for a certain period, then banks are required to take that loan out of their loan book and to put it in a separate book called a non-performing loan book. So in simple, NPLs, and for that NPL, banks are required to make provision, right? A non-performing loan is a loan that is defaulted or close to being default, right? So if it's a prudent bank, they will put, they may not wait until customer default. If they know that this customer will going to default, they immediately transfer that to NPL. Otherwise, they can wait for that timeline and do that. A loan is non-performing when payment of interest or principal are past due for a certain period. So the installment need to be paid, or the capital and interest need to be paid. Both should be paid. But if either one or both are not paid for a certain period, then that loan is classified as NPLs. This is the classification category. So we have 4 kind of classification: special mention, substandard, doubtful, and loss. Those are the categories. Now, if a loan is not paid for 3 installments or 90 days, right, that loan will be classified as special mention. So that is the starting point of NPL. Loan, if it's an installment loan, 3 installments are not paid, and other type of loan, 90 days, capital and interest are not paid. So then that loan is classified as NPL, and the first category is special mention. And until the default of 60 installment or 180 days, that bucket remains same. So special mention is 3 to 6 month default or 90 to 100 days, 180 day default. But in the case of credit card, the period is shorter, so it's only 90 to 120 days. Then even for 6 months, the customer did not pay, or 180 days or 120 days, whatever, Then that special mention loan moved to another category called substandard. That bucket remains until 12 months or 360 days. And for a credit card, it's only 180 days. Still, customer is not paying. Then the substandard loan move after 12 months or 360 day or 180 day for credit card, moves to doubtful category. Right? So doubtful category is 12 to 8 month installment or 540 days. In the case of credit card, 240. And still customer is not paying, then that loan need to be transferred to a category called lost. So any loan not paid for 18 installment or 540 days, that is loss. So in the case of credit card, anything not paid over 240 days, that is loss. Right? So these are the main classification. Then we have something called classification of multiple credit facilities. Now this is where a bank may given more than one loan to one customer. So that is possible. Now a customer might have a vehicle lease, a housing loan, and a credit card, and maybe overdraft account. So 4 different facilities given to one customer. In this, the regulation says whatever the defaulted facility is more than 30% of the total outstanding. Right? The customer is given 4 facility, say example, lease, housing loan, vehicle lease, housing loan, credit card, and overdraft. And he has defaulted the lease, for example, say, yes, defaulted is not paid lease rental for 3 months. Now bank need to check the defaulted lease outstanding, right? Outstanding balance, whether that is more than 30% of the total outstanding or not. Right? If the defaulted lease outstanding is more than 30% of the total outstanding, then all other performing loan also need to be classified as NPL. So this is called borrower classification. So that person is classified as an NPL borrower. Right? The other thing is facility classification. Now, if we are classifying leasing facility only, now that facility is in NPL, other facilities are performing facilities. Right? Now that can be done only if the outstanding of defaulted facility is less than 30% of the total outstanding. So if that is less than 30% of total outstanding, then bank need to make a facility classification. So only that lease is classified as NPL, others are classified as performing. But if the total, the outstanding of the defaulted facility is more than 30% of the total outstanding, all the facility, whether it's performing or non-performing, all the facility need to be classified. So that is called borrower classification, right? So there are 2 types of classification, facility classification and borrower classification. So this is the break even. You check the defaulted outstanding compared to total outstanding. If it's more than 30%, the entire borrower is classified. Otherwise, only the defaulted facility is classified. But after COVID-19, we have removed this because otherwise, one facility goes into NPL because of COVID, and it may be more than 30%. So the entire thing goes into NPL. So banks NPL go up. So therefore, considering that, we have taken out this multiple classification after COVID. So this is one of the exemption given, regulatory relaxation, right? The other thing is by classifying loan into this bucket alone is not sufficient. So once the bank classified its NPL into this bucket, banks are required to make provision. Now for a special mention, that is 3 to 6 month default, there's no provision in requirement. But if it's a move after that, after more than 6 months or more than 180 days, then substandard 20% provision, for credit card 25% provision. doubtful 50% provision, and loss 100% provision. So these are the provisioning requirements. Okay. And with the implementation of IFRS 9, in future, this classification will go out and provisioning will go out. Right. So these methodologies will be taken out, and I think we already done the direction, and it is again sent for consultation. So before end of this year, we will issue the latest direction on classification. And with the new direction, with the implementation, these categories are not there. Now loans are categorized into 3 stages: stage 1 facility, stage 2 facility, and stage 3 facility. Right? Now stage 3 is almost same as this. If you add all your NPL, whether it's special mention, substandard, doubtful, or loss, so if you add all together, so that will be reported under stage 3 under IFRS 9. Stage 1 are performing loans. Right? Stage 1 is almost all loans are performing. Stage 3, almost all loans are NPL. So stage 2 is an in-between category where a bank need to compute a probability of default and LGD, loss given default. And depending on the probability, PD and LGD, probability of default and loss given default, you may put that loan into stage 3, stage 1, or stage 2. So stage 3 are available for sale, that kind of a in-between category. Right? So depending on the probability of default, you may put it under stage 2. The probability of default is more, you need to put them under stage 3. Then provision, again, we don't use the word provision, but we use impairment charge. Again, that impairment charge depends on the probability of default and loss given default. Right? So with the implementation of IFRS 9, it will be more realistic. Now, I can give you an example to differentiate both things. Right? Now, under this method, classification method, say for example, one customer has taken a loan, right? And after that, he has taken a loan. He has been paying the loan for several months. Now suddenly he met up with an accident and died. Right? Met up with an accident and died. And bank manager, branch manager, of course, manager and the credit officer, they know this because they are living in the same city. But head office in Colombo, they don't know. And the regulator in central bank, they also don't know. When the bank should classify this loan as NPL. Because regulation says, if the borrower failed to pay 3 installments, should be classified as NPL. Right? So under this method, the branch manager can keep this loan as performing until 3 months, because otherwise his targets are going to miss. His NPL target go up, his recovery the branch managers are given target, so that target he may not meet. Therefore, if the manager wants, they can keep that. Right? Or even the head office want to reduce the NPL, they can keep that. Right? And say head office has granted a big loan to a construction company. With the COVID, there's a high chance of construction industry or tourism loan. We'll take a tourism loan. The bank has given a loan to a tourist hotel. Hotel defaulting the loan. So bank know this, but still they want to avoid classification, otherwise, because now we are in almost end of October, November, December, you need to prepare your accounts. So if you classify today, your NPL may go up, your profit goes down, your balance sheet is whatever the annual report or balance sheets are not, gives you a good picture. Therefore, you have 3 months. So if you wait for 3 months, then it is the next year. 3 months comes in January, right? So if a bank want to evade, to hide that, they can do, right? Because the regulation says you can wait 3 months. But once the IFRS is implemented, if the bank come to know today that person is dead or this hotel is going to default because of COVID, today itself they need to classify that loan. Today itself they need to make impairment charges. Right? So that is the realistic picture will be shown in your annual accounts, financial statements, once the IFRS 9 is implemented. Right? So that is the main weakness in this. You can wait until the time comes. Now, in case of a dead person, the loan will be classified as loss. But you can wait until 18 months to classify as loss according to this. But under IFRS, you have to immediately put that under loss and you need to make impairment charges, 100% impairment, if there is no loan protection or guarantee or collateral. Right? If it's a clean loan, then of course you need to do that. So that will be the future with regard to loan classification. And finally, compliance risk. And of course, I think I have discussed this. So compliance risk is when a bank failed to comply with any regulation. I think in the morning, someone asked this question. Now, what is the regulatory action we can take if a person or bank fail to comply with regulation? So then banks are, if you are not complying with, you are exposed to compliance and legal risk. Generally, the board of directors are responsible, but that will be delegated by the board to senior management and compliance department, and also for all other staff. So if you make a mistake, you will be punished. But the ultimate responsibility lies with the board of directors. So central bank inquire board of director. Board of directors says, no, this is handled by this officer, ask him. So then you will be in trouble. So that is compliance risk. And when there is non-compliance, these are the regulatory intervention a regulator can make. Now, if it's a very small thing, the regulator can have a routine supervision and enhanced monitoring. So if the non-compliance is somewhat severe, we can put a lot of restriction. I discussed in the morning, right? So branch expansion, credit expansion, recruitment, purchase of fixed asset, head office building, penalties, and everything we can put. So if the situation is more worse, then we can ask for rehabilitation, right? Like dividend payout restriction, we say, okay, you don't pay dividend, you don't expatriate profits, so you don't spend on capital expenditure like that. If the situation is even worse, then we can say the bank to merge with another bank. So consolidation, mergers, acquisition, all that happen. The bank is in the verge of insolvency, right? If that also not happen, we can cancel this is what happened to Pramukha Bank. So it's not a failure, but before that, a regulator identify the mismanagement and fraud, we cancel the license. So regulatory. So these are the regulatory actions we can take. If we did not cancel at that point Pramukha Bank, then it will go and fail. So that is a failure, right? So these are the regulatory actions we can take on non-compliance. So I think that's enough on regulatory model. Of course, for the exam, I would like to put some questions on basically on the Basel framework, not the computation. Don't worry about computation, but the concept and theory of the Basel III framework. There will be questions, and of course on the difference between a normal derivative and interest rate swaps. No, IIS. Inward investment swaps, the latest product introduced by the central bank, inward investment swaps, and a normal swap. So what are the exemptions given from the derivative regulation in order to do that IIS transaction? And also on market conduct. So what a dealer should do and should not do with regard to market conduct. So those three areas, there will be some question for one question for 20 marks and two MCQ kind of a short answer, 2 marks questions like that. So any other clarifications you need?
The first area is Basel. Is it the?
No, for the 20 marks question, you will get 3 or 4, 5 marks questions. So that 5 marks, one will be from Basel, one will be from the IIS, inward investment swaps, one will be on market conduct, and the other one may be a mix of or anything. Right? So MCQ, there are it's a short answer, 2 marks. So there could be 2 questions from regulatory model. Okay.
So regarding 3270 rule, hello.
Sorry.
Regarding 3270 rule NPA classification.
Yeah, 3070.
Removal of that rule is a temporary one. Oh.
It is a temporary one, but I said we already issued a consultation paper on IFRS 9 classification now. So once that is implemented, that 3070 rule automatically go out. So it is not required under IFRS 9. So until that time, it's a short-term removal. After implementation, the 3070 rule automatically go out.
Thank you, sir.
Okay. Okay, then all the best to you. Do your exams well and get through first time.
Excuse me, sir. Excuse me.
Yeah.
So I'm asking regarding the FCBU cell here, right?
Yeah.
So so when they're preparing SLR on FCBU, so all currencies, so for the USD equivalent.
No, for all foreign currencies. Again,
Sorry,
you
sir?
compute all your currencies to rupee and do the computation. Right?
All right. Okay. Thanks.
So if they are
in LKR, so all the foreign currency will be converted to rupees, and bank will do the computation.
So, could you briefly explain the impact on banking system because of this moratorium?
A very sensitive question to answer.
No, this is for the knowledge purpose.
Yeah, there will be some impact on NPA or the credit quality of banks, because now after the moratorium, I don't think people come and pay back. Anyway, this is my personal view. Nothing to do with the central bank view. So this is my personal view, and only for your knowledge, and don't share this outside. So in my opinion, the NPL will go up by a considerable amount, because people still, we don't know how long this will continue. So already the moratorium granted for over from 30th September. Now only we have that tourism sector moratorium until next year March. I don't think tourism sector will pick up at least for another 2 years. If this and we don't know for how long the COVID will continue. And if we believe that by next year March the COVID is over, airports are open, tourists are coming, and global business activities back to normal, Still for tourism, it will take another 1.5 years to recover, right? Hoping there's no other crisis in between, because the tourism is affected since 2019, right? So it's very difficult to recover. So tourism people, anyway, they're going to default in the future. And even if you take other businesses, I don't think the small scale SME sector will recover. After the big companies, they of course recover soon and they start to repay loan. But SME loans, that again, most of the SME loan go into NPL. So in my personal view is there will be a considerable impact on asset quality of banks. So NPL go up. Only good thing is our banks already made provisions. So our provision coverage is 140%, including the general provision. So therefore, when there is an NPL, they can write off with their provision. So so the NPL go up, profitability will come down, but the resilience of bank will remain strong because of the provisioning and also capital buffers. So bank failure will not happen. The resilience of banking sector will be there, but profitability goes down, NPL will increase.
Thank you, sir.
Okay. Okay, then we'll wind up the class, and thank you very much for listening to me for the last 3 weeks. Thank you, and wish you all the best.
Thank you, sir.
Sir, thank you. So is there any way, if we have any clarification, we can contact you by the mail loan phone number?
Yeah, I can give my email. I'll put a message here. I can give my email address. sarjon@cbsl.lk. That sign is not working in this keyboard. I don't know. It's a different sign appearing. So sarjon@cbsl.lk.
Okay, sir.
That sign is not working. sarjon@cbsl.lk.
Thanks. Sir, okay.
Nadika is asking posted a question. I can't understand what you are asking. Some financial institution not complete capital adequacy requirement. You are referring to bank or a finance company, because finance companies structure is different. So their capital regulations are different. So we can't compare finance company with a bank. But bank, there's no such situation. All banks are complying with the minimum capital requirement. Finance company, it's a hell of a issue. So don't compare finance company with banks. Right? Okay, thank you.